Interest rate decisions, typically made by a country's central bank, example the Federal Reserve in the US, the European Central Bank in the Eurozone, or the Bank of England in the UK, are among the most important tools in monetary policy. These decisions directly influence economic activity, inflation, and the financial markets. Here's an overview of how interest rate decisions affect various aspects of financial markets. How interest rate decisions work. Central banks set a benchmark interest rate, like the federal funds rate in the US, that influences the cost of borrowing and lending across the economy. When central banks raise interest rates, they make borrowing more expensive, which can slow down economic activity. Conversely, when they lower interest rates, they make borrowing cheaper, which can stimulate economic growth. Effects on financial markets, stock markets. Higher interest rates. When interest rates rise, borrowing costs for companies increase, which can reduce corporate profits. This often leads to a decrease in stock prices as investors anticipate lower earnings. Additionally, higher rates make bonds and other fixed-income investments more attractive, potentially diverting investment away from stocks. Lower interest rates. When rates are cut, borrowing becomes cheaper, potentially boosting corporate profits and encouraging investment. This can lead to higher stock prices. Additionally, lower rates reduce the attractiveness of bonds, making stocks more appealing. Bond markets. Higher interest rates, bond prices, and interest rates have an inverse relationship. When interest rates rise, the prices of existing bonds typically fall because their lower interest payments are less attractive compared to new bonds issued at higher rates. This leads to higher yields, the return on bonds. Lower interest rates. When interest rates fall, existing bonds with higher interest payments become more valuable, causing bond prices to rise and yields to decrease. Currency markets, Forex. Higher interest rates. An increase in interest rates generally strengthens a country's currency. This happens because higher rates attract foreign capital, as investors seek higher returns on investments denominated in that currency. Lower interest rates. A decrease in interest rates typically weakens the currency, as lower returns make it less attractive to foreign investors. This can lead to a depreciation of the currency in the foreign exchange markets. Commodities. Gold. Gold often moves inversely to interest rates. Higher interest rates make interest-bearing assets like bonds more attractive, reducing the appeal of gold, which doesn't pay interest or dividends. Lower interest rates can increase demand for gold as an alternative investment, leading to higher prices. Oil and other commodities. The impact of interest rates on oil and other commodities is more complex. Higher interest rates can slow economic growth, reducing demand for commodities. However, changes in the value of the currency, e.g., a stronger dollar, can also influence commodity prices, as most commodities are priced in dollars. Housing market. Higher interest rates. Higher interest rates increase mortgage rates, making it more expensive to borrow money for home purchases. This can cool down housing markets, leading to lower home prices and reduced demand. Lower interest rates. Lower interest rates reduce mortgage rates, making it cheaper to borrow for home purchases. This can stimulate the housing market, leading to higher home prices and increased demand. Consumer spending and business investment. Higher interest rates, higher borrowing costs can lead to reduced consumer spending and business investment, as loans for homes, cars, and capital investments become more expensive. Lower interest rates, lower borrowing costs encourage consumer spending and business investment, which can boost economic growth. Market sentiment and expectations. The impact of an interest rate decision often depends on whether the decision aligns with or surprises market expectations. If a central bank raises or lowers rates more than expected, the financial markets may react strongly. Similarly, the central bank's guidance on future interest rates, often communicated through statements or press conferences, can influence market expectations and drive asset prices even before actual rate changes occur. Central bank influence and communication. Modern central banks often try to manage expectations through clear communication, known as forward guidance. By signaling their intentions for future rate movements, they can influence financial markets even without immediate action. This communication strategy helps stabilize markets by reducing uncertainty. Interest rate decisions are powerful tools that central banks use to manage economic growth and inflation. These decisions ripple through financial markets, affecting everything from stock prices and bond yields to currency values and commodity prices. Understanding the impact of these decisions is crucial for investors, businesses, and consumers alike.